Can we trust Jerome Powell? Let's have a look. Hello everyone, Florian.heise here, and welcome to another episode of Heise Says US. Grab your stein of coffee, because I'm going to ask the question if we can trust Jerome Powell. Now, we'll look at a snippet from a recent speech he's given discussing the latest decision of the Fed and, well, his concern regarding inflation and a few other things. Now, is inflation going to be transitionary like they hope? Will it only be temporary? Is it only the result of external factors? We'll have to see. At the moment, inflation is sitting at 2.6% in March. You can see up here. So, you know, the Fed's goal is to reach 2%. And, well, they haven't kind of hit it. They haven't been there for most of the time. Most of the time they've been under it. So they will probably, the argument he'll make, is they'll be happy to be over inflation for some time, to average it out. But if the market begins to expect higher inflation, then they're going to intervene. So let's have a look. Let's have a look at this speech from the Federal Reserve President, or Chairman. Here we go.
So I actually have a couple of things I'd like to say about inflation, including addressing your question. So let me start with just saying that we're very strongly committed to achieving our objectives of maximum permanent employment and price stability. Our price stability goal is 2% inflation over the longer run.
So they want maximum permanent employment and price stability. And as I said, 2% inflation.
And we believe that having inflation average 2% over time will help anchor long-term inflation expectations at 2%.
So you hear that? They want to average it over that time. So because they've been below for so long, that means that it can run hot for a while. And they won't intervene. They want to average it out.
With inflation having run persistently below 2% for some time, the committee seeks inflation moderately above inflation for above 2% for some time. So with a little bit of context, we're making our way through an unprecedented series of events, really, in which a synchronized global shutdown is now giving way to widespread reopening of economies many places around the world.
Well, we're seeing the implications of that. On my Heise Says channel, the main channel, you can see we've been discussing global shipping. And just recently I did a video today about, well, shipping containers being stacked so high on ships that they're toppling over. So they're overloading to try and meet demand. So it's all a bit, well, overheating at the moment, a bit crazy, understandably.
In the United States, fiscal and monetary policy continue to provide strong support. Vaccinations are now widespread, and the economy is beginning to move ahead with real momentum.
The problem is that just the fiscal and monetary policy, if it provides support, but all you're doing is increasing the trade deficit, does it really create any jobs? I guess it does in the flow through of these goods through the economy, and then that's really all they want. They're just looking at jobs, and they're hoping it'll kickstart everything.
During this time of reopening, we are likely to see some upward pressure on prices, and I'll discuss why. But those pressures are likely to be temporary, as they are associated with the reopening process. And an episode of one-time price increases as the economy reopens is not the same thing as, and is not likely to lead to, persistently higher year-over-year inflation into the future, inflation at levels that are not consistent with our goal of 2% inflation.
So he's arguing that it's only going to be temporary. So what do you think, guys? Let me know in the comments. I'll have a shot of coffee. Do you think it's only going to be temporary inflation? Some people are making the argument this is essentially the beginning of hyperinflation, the first step of it. And others are arguing, no, we're going to go into a deflatory time period. What do you think, everyone? Or do you trust what Jerome Powell is saying, what the Fed?
Over time. Indeed, it is the Fed's job to make sure that does not happen. If, contrary to expectations, inflation were to move persistently and materially above 2% in a manner that threatened to move in longer-term inflation expectations materially above 2%, we would use our tools to bring inflation and expectations down to mandate-consistent levels.
So if the bond market started to show signs of expectations of longer inflation, Powell's just said that they'll use their tools to intervene. What would that do to the housing market? What would that do to the value of the US dollar? What do you think, everyone? How will that flow through to us over here in Australia?
And I would say, if I may, that is a principal difference from we're all very familiar at the Fed with the history of the 1960s and 70s, of course. And we know that our job is to achieve 2% inflation over time. We're committed to that, and we will use our tools to do that. So that's a very different situation than you had back in the 1960s. There are many, many differences, actually. Let me talk quickly about the two reasons, two or you could say three, but really two main reasons why we think inflation will move up in the near term. The first is the base effects. 12-month measures of inflation are likely to move well above 2% over the next few months as the very low inflation readings recorded in March and April of last year drop out of the calculation. That process has already started to show up. You saw it in the March CPI reading, and you'll see it later this week in the PCE price data. These base effects will contribute about 1 percentage point to headline inflation and about 0.7 of a percentage point to core inflation in April and May. So significant increases, and they'll disappear over the following months, and they'll be transitory. They carry no implication for the rate of inflation in later periods. So that's base effects. The other big one I would talk about is bottlenecks. So this is what we're seeing in supply chains in various industries, and we're in close touch with all of these industries. You know, the Fed has a network of contacts that is unequaled in businesses and in nonprofits, for that matter, too. So what do we...
And this is one thing to consider if we are seeing inflation due to bottlenecks, due to supply and demand. You've got to remember, these are price signals in the market, so the market should respond to it, and prices should, well, reach a fair market value. If something is very expensive, people are going to find ways to provide that product. Remember, these are price signals.
What do we mean by a bottleneck? A bottleneck really is a temporary blockage or restriction in the supply chain for a particular good or goods, something that slows down the process of producing goods and delivering them to the market. We think of bottlenecks as things that in their nature will be resolved as workers and businesses adapt, and we think of them as not calling for a change in monetary policy since they're temporary and expected to resolve themselves. We know that the base effects will disappear in a few months. It's much harder to predict with confidence the amount of time it will take to resolve the bottlenecks, or for that matter, the temporary effects that they will have on prices in the meantime. So, I'll just sum up and say we understand our job, we will do our job, and we are focused, as you've seen, for many years, we've been focused on inflation deviating below 2%, and we used our tools aggressively to keep it back up at 2%. If we see inflation moving materially above 2% in a persistent way that risks inflation expectations drifting up, then we will use our tools to guide inflation and expectations back down to 2%. No one should doubt that we will do that. This is not what we expect, but no one should doubt that in the event we would be prepared to use our tools. Question. So I actually have a...
So there you have it, everyone. If long-term expectations of inflation go up, they'll use their tools to bring it back down. And what are their tools? They'll intervene in the market. I wonder what that'll mean for interest rates, among other things. So what is the solution to this, everyone? Or the lessons we can take away? Now, because you'll have people that'll be saying, inflation's going to the moon, we've got hyperinflation, put everything you own in Bitcoin, buy your gold, get your silver, get out of the US dollar. But I just thought I'd bring up this quote from John Maynard Keynes. The stock market can remain irrational longer than you can remain solvent. Are you going to bet against the Fed, everyone? If enough people believe and trust in what the Fed is doing, well, won't that make it so more than anything? Can we trust Jerome Powell? Is he just simply trying to, alleviate fear of the market? Psychology is a big part of it, everyone. What do you reckon? What's your strategy? And where do you think it'll take? Do you trust Jerome Powell? Or do you think, this is just the first step to hyperflation or deflation? Let me know your thoughts and opinions on that one in the comments down below. Thank you all for watching. If you're a fan of the channel and enjoy the content, there are a few ways you can support us. You can join us on YouTube or Patreon. You can support us by buying our shares, by signing up for Self-Wealth or Stake. For the crypto traders out there, you can use independent reserve as well and help. A portion of your fees will help the channel. You can also help us out by using our affiliate links at Amazon, eBay, Independent Reserve, or Aussie Broadband. You can buy a merch from Heise Says. We make handmade pocket squares, or from Teespring. You can get coffee mugs and things like that. Finally, you can support us using Gold Pass or PayPal. Take care, everyone. Have a great day, and I'll see you in the next episode. Bye for now.